You ever notice how money feels weirdly slow at the beginning? Like you're doing the right things. You're saving, maybe investing a bit, cutting back on spending, trying to be disciplined. But month after month, your account balance barely moves. It honestly feels like nothing is happening. You check your numbers and think, is this even working? And then something strange happens that most people don't talk about. There's this phase shift. At first, building wealth feels like pushing a car uphill. Every dollar is effort. Every gain feels small, and because it's slow, people assume it will always be slow. So they quit, or they loosen up, or they start spending more because in their mind, the progress just isn't worth it. But here's the part that trips people up. At some point, without warning, things stop feeling stuck. The same habits that felt useless suddenly start to compound in a way that feels almost unfair. It's like the system quietly switches gears while you weren't looking. And that raises a pretty uncomfortable question. Why does money feel like it's not working, right up until the moment it starts working a lot? And more importantly, what changes at that point that most people completely miss? Because the truth is, the first 100K isn't just another milestone. It behaves differently from everything that comes after it. And understanding why that happens changes how you think about money entirely. Hi, I'm Humphrey, and over the years, one of the most consistent patterns I've noticed isn't about intelligence, income level, or even how financially responsible someone thinks they are. It's about where they are in the wealth building timeline. When you look closely at people who are just getting started, there's this almost universal frustration. They're doing the basics, saving what they can, trying to invest consistently, avoiding obvious financial mistakes, but the progress feels painfully slow. Every decision feels high stakes because every dollar still matters individually. Then you look at people who have already crossed a certain threshold, and the experience is completely different. The same percentage returns, the same market movements, the same behaviors, they just produce a different emotional outcome. Things start to feel less like effort and more like momentum. What becomes really clear over time is that the math of money doesn't actually change, but the way it behaves does. A 10% return is still a 10% return. What changes is what that 10% is acting on, and that completely reshapes how fast things seem to move. And that's where most people misunderstand wealth building. They assume it's linear when in reality, it behaves more like a curve that bends sharply after a certain point. If you're in that stage between 0 and your first 100K, there's a very specific feeling that comes with it, even if nobody really talks about it openly. You're doing what you're supposed to do. You're putting money aside each month. Maybe you've started investing. You've cut out some unnecessary spending. You think twice before buying things. You're generally more aware of your finances than most people around you. But despite all of that, the progress still feels underwhelming. Your savings account goes up slowly enough that it almost feels like it's not worth tracking. Your investments move up and down, but the overall line barely seems to change. And when you do the mental math, it's hard not to think, at this rate, how long is this actually going to take? On top of that, you're watching other people who already seem far ahead. People who talk about portfolios, real estate, or just having that financial cushion where decisions feel easier. And it creates this quiet tension where you're putting in effort, but the reward doesn't feel proportional yet. That mismatch is usually where motivation starts to fade for a lot of people. Not because they're doing anything wrong, but because the early stage of wealth building is emotionally unrewarding even when it's technically working. And here's the part most people miss. This is exactly where most people stop. Right before the point where compounding starts to become visible, not just theoretical. So if you zoom out and ignore the day-to-day frustration, wealth building actually tends to follow a pretty predictable structure. It's not random, and it's not purely about luck or timing. It moves in phases. The first phase is what I'd call the grind phase, roughly from 0 to 100K. And in this stage, something important happens that most people don't fully realize. Your own contributions are doing almost all the work. If you're saving, say, $10,000 a year, that's the main driver of your progress. Even if you're investing and getting a decent return, it barely moves the needle in a noticeable way. You could get a 7% return on a small portfolio, and it still feels insignificant compared to what you're personally adding. So everything feels linear. You put money in, and slowly it accumulates. There's no real momentum yet, just consistency. Then you reach what I call the inflection point, which usually shows up somewhere around that 100K mark. And this is where things start to change in a way people don't expect. Now, your investments begin to contribute in a meaningful way. A 7% return on 100K isn't just a small number anymore. It starts to feel real. You begin noticing that even in months where you didn't contribute much, your balance still moved. It's subtle at first, but psychologically, it's huge. This is the moment where money stops feeling like something you're pushing forward alone and starts feeling like it's beginning to help you. And then comes the acceleration phase. Once you're past that point, your returns and your contributions start working together. The money you've already accumulated begins to generate meaningful growth on its own. It's like a snowball rolling downhill. At first, it's small and slow, but once it gains size, it starts picking up more with every rotation. At that stage, even a modest percentage gain can mean thousands of dollars, not just a few hundred. And that shift is what changes everything. The easiest way to understand compounding is to separate two things people often mix up: adding money and multiplying money. When you're early in your financial journey, almost everything feels like adding. You put in $500, $1,000, $2,000 from your paycheck, and that's what drives your progress. Your money is basically growing because you're feeding it more money. The return from investing is there, but it's small enough that it doesn't really change the outcome in a noticeable way. Now compare that to when you already have something like $100,000 invested. If both portfolios earn the same 7% return, the experience is completely different. On $5,000, that's $350 in a year. You might not even feel that. But on $100,000, that same 7% is $7,000. That's not background noise anymore. That's something you actually notice. What's interesting is that the percentage didn't change. The effort from the market didn't change. The only thing that changed was the base it's working on. And this is where time starts behaving differently too. On smaller amounts, time feels slow because growth is mostly dependent on your actions. But on larger amounts, time starts doing real work for you. It's like the difference between pushing a bike uphill versus letting gravity take over once you're at the top. What really makes this important is that wealth building doesn't exist in a vacuum. It sits inside real life decisions, real time, and real consequences. If you start early, even with small amounts, you're giving compounding more time to actually do its job. And that sounds obvious, but the impact of it is way bigger than most people realize. Because in the beginning, progress feels slow either way. Whether you start at 22 or 32, those early years don't feel dramatically different on a monthly basis, but they are fundamentally different in outcome. The problem is that time before 100K is not just slow time, it's the most powerful time you have, even though it doesn't look like it. And if you miss it, you don't just lose a few good years of growth. You lose the period where your money could have been building its own momentum from the ground up. Inflation makes this even harder to ignore. When your money is growing slowly, barely keeping pace, or not even that, it's effectively losing purchasing power in real terms. So even though your balance might be going up, what it can actually buy in the future isn't keeping up in the same way. And this is where income alone can be misleading. A higher paycheck helps, but income by itself doesn't build lasting wealth unless it gets converted into capital that grows over time. There are plenty of high earners who still feel financially stuck because their money never gets the chance to compound meaningfully. The real goal isn't just to make more money, it's to reach the point where your existing money starts generating new money in a way that becomes noticeable in your everyday life. And the uncomfortable truth is that the time it takes to reach that point matters a lot more than most people think, because the earlier you get there, the more of your life gets shaped by compounding instead of constant effort. So if you strip everything down, getting to 100K faster really comes down to a few controllable levers. And the key thing to understand is that you don't need anything complicated at this stage. In fact, complexity usually slows people down more than it helps. The first lever is income optimization. Early on, your earning power matters more than almost anything else. That doesn't necessarily mean starting a business or chasing something extreme. It can be as simple as improving your core job skill, negotiating raises, switching to roles with higher pay ceilings, or adding a side income stream that actually complements what you already do. The goal isn't to work endlessly, but to make sure your time has a higher output value. The second lever is your savings rate. This is where a lot of the acceleration happens. If you can consistently save a meaningful portion of your income early, you're basically compressing the time it takes to reach that first 100K. It doesn't require extreme deprivation, but it does require clarity on what's temporary and what's lifestyle inflation. Then comes investing, and this is where simplicity wins. You don't need complex strategies here. For most people, consistent investing into broad index funds is enough. The real advantage is not picking the perfect asset, but just staying in the game long enough for compounding to matter. And finally, consistency systems matter more than motivation. Automation is huge here. Automating transfers, investing on schedule, removing the need to constantly decide. Because every decision you remove is one less chance to drift off track. When you combine higher income, disciplined savings, simple investing, and automation, you're not trying to get rich fast. You're just removing friction from the process. And that's what actually gets you to 100K faster than anything else. What I've noticed is that most people don't actually fail at building wealth because they're doing nothing. They struggle because they're doing the wrong things for the phase they're in. One of the most common mistakes is trying to optimize returns too early. People start thinking about advanced strategies, chasing higher yields, or trying to outsmart the market when they're still in the sub 100K stage. But at that point, returns aren't the main driver yet, contributions are. So a lot of energy gets spent on things that barely move the outcome. Another pattern is distraction from trends. Whether it's crypto cycles, meme stocks, or whatever the newest hot opportunity is, it pulls attention away from consistency. And the issue isn't necessarily that those assets are good or bad, it's that they introduce volatility into a phase that actually depends on stability. Inconsistent investing is another big one. People start strong, then pause when markets feel uncertain or when life gets busy. But at this stage, stopping and restarting has a much bigger impact than most people realize because compounding hasn't had time to build momentum yet. Then there's lifestyle inflation, which often happens quietly. Income goes up a bit and spending adjusts just as quickly. So even though someone feels like they're progressing, their savings rate doesn't actually improve in a meaningful way. And finally, a lot of people simply quit too early. Not because the system isn't working, but because progress in this phase doesn't feel like progress. Most of these mistakes come down to one thing: misreading the stage they're in. They're applying later stage thinking to early stage wealth building. And that mismatch slows everything down more than anything else. At this point, I'm curious where you actually see yourself in all of this. Because when people hear about the 100K milestone, everyone interprets it a little differently depending on where they are right now. Some people are just starting out, trying to build that first few $1,000s of savings. Others are somewhere in the middle, where they've been consistent for a while, but the progress still feels slower than expected. And then there are people who are right on the edge of that 100K mark, where things are starting to shift, but it still doesn't feel fully different yet. So I want to ask you directly, where are you on that curve right now? And more importantly, what part of it has actually felt the hardest for you so far? Is it the consistency of saving every month, even when life gets expensive? Is it watching your investments move, but not really feeling like they're changing your life yet? Or is it more the mental side of it? Feeling like you're doing the right things, but not getting the emotional payoff that you expected? Because a lot of people describe this same slow phase, where everything technically works, but nothing feels like it's accelerating yet. And that's usually the point where people either adjust their strategy or quietly lose momentum without realizing it. So I'm genuinely interested. Do you feel like you're still in that slow building stage, or have you started to notice any shift yet in how your money is behaving? I read through a lot of patterns in this space, but hearing real experiences is usually where the most interesting insights come from. If there's one thing to take away from all of this, it's that the first 100K is slow by design. Not because you're doing something wrong, not because the system is broken, but because structurally, that's just how wealth building starts. In the beginning, you're laying down the base layer. You're building the habits, the discipline, the consistency, and most importantly, the initial pool of capital that everything else will eventually grow from. And that's why it feels so different from what comes later. Early on, progress is mostly driven by what you put in yourself. Your effort is doing almost all the work. So naturally, it feels slow, repetitive, and at times even unrewarding. But that doesn't mean it isn't working. In fact, it's the exact opposite. This is the part that determines everything that comes after. Because once you get through this phase, something important changes. You finally reach the point where your money starts to contribute meaningfully alongside you. And that's the shift most people don't recognize early enough. Wealth doesn't suddenly become easy. You don't wake up and find a shortcut. What actually happens is that the same level of effort starts producing different results, because now you've built enough capital for compounding to matter. So the real takeaway is pretty simple. The early phase isn't where wealth feels exciting, it's where wealth gets built. And the people who stay consistent through that slower period are the ones who eventually experience what it feels like when time, returns, and capital start working together instead of just you doing all the work alone. If this idea of the first 100K shifting how money behaves actually clicked for you, the next natural step is just understanding how to build the habits that get you there without overcomplicating it. A lot of what slows people down isn't lack of effort, it's just not having a simple framework for things like how much to save, where to actually put your money early on, and how to avoid the common mistakes that quietly drain progress over time. So it might be useful to look deeper into topics like how to build a basic investing system that doesn't require constant decision making, or how to structure your savings so it actually supports long-term growth instead of just sitting idle. Even understanding the basics of index investing or how to increase your income in a way that compounds over time can make a noticeable difference in how fast you move through that early stage. The goal isn't to rush anything or force results. It's just to make sure you're not unknowingly working against the very system you're trying to benefit from. And honestly, once you start seeing how these pieces fit together, the whole process becomes a lot less random than it first appears.